Good afternoon, everybody. I'm Dr. Snehachal Agarwal, the moderator of this webinar. We are very delighted to welcome you all in this webinar that has been organized by the CPE Committee of the ICAI. The topic for the webinar today is Intricacies and Provisions Relating to Financial and Related Party Transactions under Companies Act and Audit, Assessment and Litigations in GST. We'll be starting this seminar in a short while, but before that, let me give you a little bit about the CPE committee. So the profession of CA is growing by leaps and bounds, and there's been a phenomenal growth in this. But we have to aim at developing our knowledge edge so that we can fulfill the expectations of the society. And with that aim, the CPE committee of ICAI keeps on, updating our knowledge with different kind of programs and such kind of workshops to make the word of CA synonymous with excellence in service. And the CPE committee has always been proactive to the emerging needs of its members, enabling them to acquire contemporary knowledge and skills to face the challenge effectively by organizing CPE programs and providing adequate opportunity. So the program for today afternoon will be as follows. We'll be having two sessions by two very veteran speakers. The two sessions will be of 1 hour each, and the topics will be intricacies in the provisions of Companies Act 2013 relating to financial and related party transactions. And the second session will be audit, assessment, and litigations under GST. They are both our eminent speakers. They'll be talking about two emerging areas of the professional interest, and I hope you'll all enjoy this seminars along with a lot of learning. Uh, I think Mahesh Gupta sir has joined in, and he needs actually no introduction, but I'll still try to introduce him. So Shri Mahesh Gupta sir is a certified CSR professional from ICSI. For last 35 years, he's a popular faculty at all prestigious management institutes and addressed multiple sessions on various platforms. He has been chairing various committees like corporate law, capital market, indirect taxation, etc. And having been his own student, I can vouch for him and his corporate excellence. Mahesh Gupta sir, welcome you and over to you, sir.
Thank you, Achal. Good afternoon to you all. It's my proud privilege to address participants throughout the length and breadth of the country on this important topic of intricacies in the financial and related party transactions under the Companies Act 2013. Friends, you know very well that the Companies Act 2013 was basically the outcome of various scams which have taken over a period of time under the corporate sector. Be it, you can say, the Sahara or Shraddha or Satyam. A financial discipline was needed in the minds of the government, regulators, that yes, there should be the law which should be changed because most of the transactions were such by which either the funds were diverted or used in the related parties. Therefore, 2014, 1st April, when this act came into force, it was a very, very stringent piece of legislation, a new legislation, though less number of sections, 658 sections of the Companies Act have been reduced to 470, but more a rule-driven law where the lot of powers had been delegated to the Ministry of Corporate Affairs or to the central government. Now, I'll say the core of this entire act, basically 4 or 5 sections, which were very important in the amendments, I would like to deal with you today. Now, one is as far as the financial transactions are concerned, we know very well that the financial transactions are borrowing and lending. Not only the borrowing and lending, which form part of the financial transactions, there may be many and multiple related party transactions for buy and sale of goods and services, or maybe for materials or immovable properties. All of these things to some extent have been relaxed, regulated, but it has gone to a very, very different regime, I would say. In the year of 2014, when the new provisions were made applicable through the Companies Act 2013, there was no distinction initially in the private and public companies, because we had been habituated of enjoying a lot of we had been habituated in enjoying lot of privileges, lot of relaxations for the private companies. But this act did not make any distinction. And what happens in that process, there was a big hammer on the private companies functioning. And ultimately, after much representations which were made to the Ministry of Corporate Affairs on 5th June 2015, after 1 year, 1 month and 5 days, central government has relaxed and issued a notification for 4 different classes of companies. You can say the Section 8 company, government companies, or private companies, from various provisions of the act, and tried to restore the old system where the relaxations and the this thing was available. Due to paucity of time, I'll just cut short all these things and let me come to my topic. See, today, friends, we will discuss on the financial transactions where there is, just a minute. Wherever there is, friends, the question is, first is deposits. When I talk about the borrowings as the deposits, deposit is also a borrowing. Taking loan is also a borrowing. Let me share the screen. Just a minute. See, the borrowing and lending, that is one part as far as the financial transactions are concerned. And second part is, friends, on the related party transactions. Now, as far as the financial transactions are concerned, we'll discuss today the borrowings in the form of deposit by a company. The Companies Act 2013 through Section 73 and various rules made thereunder restricts the borrowing from various people other than the exempted borrowing. As far as the lending is concerned, on the lending fronts, loan to the related parties is prohibited to some extent under Section 185(1), while loan to the companies which are related or directors are having some interest in, we can give the loans by passing a special resolution. That relaxation was given in 2017, and initially from 2014 to 17, almost 3.5 years, the life was very miserable when a holding company was giving any guarantee even for the loan obtained by the subsidiary company or other parties. So I'll say the partial relaxation has been given as far as the lending is concerned. Loans and investment guarantees and the securities under Section 186 will share and will deal with this matter, which would be a very different. Why? Because this is the corresponding to Section 372 of the erstwhile Companies Act 1956. Here, relaxations are also given, but the life has been made slightly miserable. As far as the related party transactions are concerned, under Section 188, when we talk about the related party transactions, it may have the buy, sell, lease of goods, material or services, buying and selling of immovable properties. When we go through the LODR provisions which are applicable in case of a listed company, the definition of related party transaction is slightly wider. It says related party as defined under accounting standards, or transactions as defined under accounting standard. From that objective, when we look into, even the financial transaction would fall under the purview of related party transaction, though it is a financial transaction. So in a case of a listed company, related party transaction, whatever it is, would also be, all financial transaction would also be related party transaction from that angle. Secondly, under the LODR, there is a very important provision which speaks that whether any consideration is taken or not taken, consideration has flown or not flown, it still be deemed to be a related party transaction for the listed entities. Many times what happens, there are group companies. One group is or one company is owning the premises. In the same premises, you have the multiple companies registered offices which are in the same group. You just pass a resolution, file form INC 22 for the having registered office situated over there. Now, while the registered office is in that situation, maybe without rent because it is owned by the company or the holding company, whether it is a related party or not, if your company is a listed company, it is a related party. Under section 188, there are three models, what I would say. One, if the transactions are at arm length in the ordinary course of business and are repetitive in nature, if the company has an audit committee, the power could be delegated to the audit committee and an omnibus approval may be possible. Now, secondly, if it is not repetitive in nature, it is at arm length in ordinary course of business, section 188(1) will not be applicable or is not applicable. It is exempted, but is still entry in the register of member is to a register of contract is to be made. As far as what is arm length, what is in ordinary course of business, we'll have a deliberations, friends, slightly later on this issue. As far as the borrowing is concerned, section 73 is very important. Earlier, under the old Companies Act 1956, we had the companies section 58A. To understand the provisions of section 58A, then we compare it with the Companies Act 2013 through section 73. See, from 1956 to 1974, all deposits were regulated by RBI. Section 58A under the erstwhile Companies Act 1956 was introduced or inserted by the Companies Amendment Act 1974. What happens then? Through this, the non-banking, non-financial companies' deposits have been shifted or regulated, or powers were shifted to MCA, which was earlier DCA, Department of Company Affairs, which is now MCA, Ministry of Corporate Affairs. So, non-banking, non-financial company transactions, friends, these are being governed by Ministry of Corporate Affairs. Most of the time when we deal with the company, we just understand because the Companies Act section 73 and the company's acceptance of deposit rules talks about the companies, but NBFC and HFC, non-banking financial companies and housing finance companies, there are separate directions by Reserve Bank of India. And earlier, there was this NHB, National Housing Bank, which used to be the regulator. Now these regulations are also with RBI for HFC, housing finance companies. The biggest after the Satyam scam, after the Sahara scam, the deposit acceptance has been made very stringent. Section 73 discusses about the eligible companies, and eligible companies are only allowed to accept deposits from the public. Now, which are the eligible companies which is defined in section 73? Eligible companies are those companies which has net worth of 100 crore or more and turnover of more than 500 crore or more. So, if any of the thing is missing, my turnover is less than 500 crore and net worth is less than 100 crore, I am not eligible company, I am ineligible company. An ineligible company can take deposits only from a member, not from public. So only a very few companies which are large in size, having turnover of 500 crore and also having net worth of 100 crores would be eligible to take the deposits, not otherwise from the public. So that was a very big change which was brought in. When section 73 was brought into effect from 1st April 2014, section 74 also came in play because many borrowings which were earlier exempted, which were not deposits, now had fallen suddenly into the category of deposits. Now, repayment of deposits which were earlier not deposits, but as now 1 year timeline had been given through the section 74 of the Companies Act. Going further, friends, when we go through the rules, the company's acceptance of deposit rules, see, this is, I'll say, for the financial discipline, any company, for the auditors who are acting as the statutory auditors in the company, or even the company managements. Everyone should be aware that from where you can resort to the funding of the company. If a company raises funds through the capital infusion, in capital infusion, you may have the equity shares, you may have the preference share capital, then obviously it is not a no issue at all. But many a times, most of the corporates have concern that if the capital is infused, it is permanently blocked, number one. Or secondly, they have to have the matching authorized share capital to pay 0.75% by way of registration fee to the government, or stamp duty on increase in the authorized capital. There had been a lot of issues. Can a company issue shares at premium just to avoid that payment? The companies can issue shares at premium, but Section 56, subsection 2, clause 7 of Income Tax Act 1961, it does not permit. It says that the issuance of shares has to be at a fair value, for which a valuation report is required from an approved valuer from IBBI now. So therefore, only a fair value has to be used. You cannot charge hefty premiums or huge premiums which are unwarranted, unjustified. Otherwise, there would be taxation angle. As far as the Companies Act is concerned, when we talk about Section 62 or we talk about Section 42, again, a valuation is required except in the rights issue. But in rights issue for income tax, Section 56 is applicable. Therefore, it has to be again at a fair value. Now, let's come back to the borrowings, friends. See, every professional who is associating with a company should guide the promoters, because promoters are very, very, like I'll say, lethargical in compliances on account of ignorance many times. Secondly, many times on account of their need of the funds. So they bring the funds and ultimately the certification comes to the professionals. Therefore, their hands are tied. How to certify, how much to certify, how much to qualify or not. So it's a very, very like tricky question which comes like in front of all of us. Now, therefore, let's now discuss that which amount which is borrowed is not a deposit. It means any company which is falling or borrowing from these sources, there is no restriction as far as the borrowing is concerned. But if my company is a public limited company, my total borrowing without passing a special resolution under Section 181A, I cannot exceed the borrowings without passing a special resolution. So in all public companies, the company should ensure that under Section 181, 180 bracket 1, Clause A, they should pass a special resolution, file Form MGT 14 with the Registrar of Companies within 30 days of passing of the special resolution, and seek approval of the members of the company to have the maximum borrowing within this limit. So that is one thing in the listed public limited companies. Other companies, because private companies, Section 180 is not applicable, but still, see, a company may have the borrowing from the central government or a state government. In many cases, the central or state governments are also giving loans to the corporates for their projects. Therefore, that money could be borrowed subject to other provisions, but it is not a deposit. We borrow from foreign government or foreign institutions. Any foreign government. Why any money received from a foreign source is not a deposit under Companies Act? Because the basic reason is the same, that the FEMA is applicable. If a company is complying with the FEMA provisions, all due diligence, all due compliances would be taken care of by the provisions which are given under FEMA. Therefore, for Companies Act, it is not an issue. So Companies Act, that is the reason why the foreign funding or foreign loans had been allowed. Now, loan or facility availed by a company from a banking company or banks. So whether it is a banking company or banks, when I say the banking company, it could be a private sector, maybe nationalized, maybe the SBI, even the cooperative banks. When we borrow money for our business, for our projects, it is not a deposit. It means you can take subject to Section 180 of the Companies Act. A company borrows, whether private or public, from the public financial institutions. It is also not a deposit. It is an exempted borrowing, I would say. Next is, friends, the commercial papers. Commercial paper is also exempt very specifically under the Companies Acceptance Deposit Rules 2014 from any other company. a company receiving from any other company. See, we used to call it the ICD, intercorporate deposits. Now, there had been a lot of issues. If a company issues debentures and your company is a subscriber to the debentures issued by the other company, now whether you have to follow all the provisions for debentures or not, the question is, see, debentures, whether it is unsecured or other thing, there is a specific provision. Debenture is not a borrowing, debenture is a security. Therefore, being the security, we have to comply with the provisions of Section 71 also wherever applicable. Therefore, once I say the money received by a company from any other company, I am talking about the plain vanilla loan amount, not about any other security or another hybrid security. Therefore, once I say it is normally dealing with the ICD, intercorporate deposits. Security application money pending allotment, any security application money, what we used to call it the share application money, which is pending allotment, it is lying with the company, it is not a deposit, provided it is refunded within 15 days. If it is not refunded within 50 days, it is a deposit. And maximum time for which a share application or security application could be retained is 60 days under the deposit rules. Here, friends, a question which I would like to deliberate with you. See, once we issue the shares, Section 62 or Section 42 are applicable. When it is a private placement, it is Section 42. When it is the rights issue or preferential offer, or I can say the ESOP, then it is Section 62, which is applicable. Now, to have the separate security application account is the need in case of private placement and preferential offer as per the issue of share capital rules. But in rights issue, it is not talked about. Therefore, many a times we professionals suggest, and other professionals do insist upon to the promoters, that in right issue, this provision is not there under Section 62 or under Section 62. Therefore, we need not to keep the share application money in a rights issue in a separate bank account. But my concern is Section 73 is an independent section which says securities application money pending allotment. It does not say preferential offer or right offer or something else. It is not exempting only rights offer. It says that any share application money. And it is pending allotment. I am not allowed to use. I have to make a refund. That is also the condition. Therefore, if I am taking the share application money or securities application money in case of the rights offer from the existing shareholder and crediting that amount directly to my current account, you are utilizing before allotment all these shares. Therefore, you are using the application money, which is violation of Section 73. Therefore, towards the better compliance of the law, though it has not been so far very much touched and hyped provision, many people are doing, there is no mechanism. But on the better compliance side, we should always insist upon from the corporates that even in the rights issue, we should keep the share application money to the rights in a separate bank account, which you have to open otherwise for the preferential issues or for the private placements. Now, another type of exempted borrowing, which is not a deposit, is some money received by a company from its directors. A person at the time of giving the money should be a director, and money should have been given out of his own funds, not out of the borrowing. Once I say out of the own funds, not out of the borrowing, then obviously it should be his own funds. Suppose he borrows the funds by pledging shares of a company, pledging his investment from a bank and gives the loan to the company in which he is a director, again, it is not allowed. Secondly, can a company operate a current account with the directors? That is also not allowed, because each time whenever money is remitted by a director, he has to give a separate declaration along with details of the amount what he gives, that it is given out of his own funds, not out of the borrowed accounts. Thirdly, suppose there is a joint account of the director and is some family member, maybe his wife or husband, maybe son or daughter, where the first name is of his relative, then this money will also not be allowed in all cases. So director can give out of own funds from the account which is his own, and he is the first name holder if there is a joint account. Secondly, friends, next is in case of a private company, relative of a director could also give the loan to the company. In private company, relative of a director, public company, this exemption is not available. Now, once I talk about the relative of the directors, friends, relative, who is called as a relative? The definition of relative is given under the Companies Act. It is given under Income Tax Act. Definition of relative was there under Companies Act 1956 and now under 2013. When I compare 2013 with the 1956 definition of a relative, from 22 relations, the definition of relative is pruned now to 9 relations. Second degree, it means grandparents and grandchildren are no more relative under the Companies Act now, under the new provisions of 1956. Under section 2, subsection 41 of the Companies Act 1956, suppose there is a director, then his father, mother, father's father, father's mother, mother's mother, mother's father, brother, brother's wife, sister, sister's husband, son, daughter, son's wife, daughter's husband, then their children with spouses, all those plus spouse. They were all the relatives. Now the second degree, upper and lower, it means grandparents and grandchildren are not falling within the definition of a relative, only single degree. Therefore, spouse is a relative for a director, husband or wife. Then you have the relation father and mother, son and daughter, son's wife and daughter's husband, and you have the brother and sister, but not the spouses of brother and sister. And grandchildren are not relative. It means when I talk about the borrowing, exempted borrowing, which are not deposits, my borrowing capacity has been reduced. Earlier, I was eligible in a private company to borrow from 22 relatives very freely. Now I can borrow only from 9 relatives. Here in the definition of relative, earlier also and now also, the HUF, but it is not per se HUF, it is member of the HUF. So in a particular HUF in which the director is a member or karta, co-partner or karta, now in the same HUF, some other person is involved, he is also one of the co-partner or karta. Then such person also can give loan to the company. So because then such person is a relative, HUF per se is not a relative. In many of the financial statements, it is noticed, then loan is given by the HUF of a director to the company. It is clear violation of the Companies Act deposit rules. It says relative definition. When we go through the provisions of the term relative, relative means an individual, number one. Secondly, it says member of the HUF, not the HUF per se. Now, next, friends, we say about the bond and debentures. Now, every bond and debenture issued by the company to borrow funds, bond, while a company issues the bonds, company issues the debentures, company is taking money. But under the company's acceptance of deposit rules, the bond has to be secured. Debentures have to be secured. Unsecured debentures are deposits. And if it is a deposit, I have to be eligible because they are not my members. So eligible deposits, obviously then my debentures should be fully secured. Market value of security should be greater than the debentures amount. Then I can issue the debentures and borrow the money. Secondly, I can also issue compulsorily convertible debentures having no put and call option. The conversion period shall not exceed more than 10 years. Then such CCD is also not a deposit. It means you can issue to any person, any party, any company, such CCD, which are compulsory convertible. If I issue partly convertible debentures, I issue not convertible debentures, but which is not secured, it is a deposit which I am not eligible to take. Secondly, thirdly, it says as far as the bonds and the debentures are concerned, listed bonds or listed debentures. If the debentures are listed, though they are unsecured, it is also allowed. So either if they are secured, they have to be fully secured. If they are not secured, then they may be CCD to be convertible into 10 years, or they are unsecured, then could be listed also. So 3 types of debentures could be issued by a company. Otherwise, it would fall within the definition of deposit because it is not an exempted borrowing. And the company has to comply with many such provisions to create the security and have so many things. Another exempted borrowing, friends, in the deposit is non-interest bearing amount received and held in trust. What is the amount held in trust? It is not a trust, private or public trust or a charitable trust. But suppose there is a deposit which come to due, preference shares are due for redemption, debentures are due for redemptions, dividend which was payable, but my debenture holder, shareholder, preference shareholder has not claimed and money is lying with me. That is, it is lying in trust, so it is not a violation. I dispatched the dividend warrant, I dispatched the redemption warrant, but it has not been claimed so far, lying unclaimed with the company, then it is money held in trust for someone. Now, friends, exempted borrowing, another very important thing. See the business advance, it has hit very badly. Titan Jewelry used to accept the deposits for a longer period just to have every month the deposit. And then after 3 years, every month, 36 months installments deposit they pay. The depositors used to pay to the company, and then the company, they can buy the jewelry from the Titan. Now, that was the practice, but when this law came in, around 25,000 crore rupees were refunded by this company to the various stakeholders or deposit holders. Now, the very important is business advance cannot be for more than 365 days from the date of an entry. Now, here many questions arises. Many times, suppose you are having a power company. Now, many of the customers can pay you in advance. Some of the connecting person who is using your services can pay advance for 1 year, 2 year, 3 years. Earlier, there used to be the car bookings, gas cylinder bookings, which used to take more than 365 days, 2 years, 3 years, 4 years times. Now, this is not possible. If you give the advance, the person or the company which has taken such advance has to be adjusted against the supply of the goods or services within 365 days, or money has to be refunded. It means you cannot use the buyer's money, advance money, for more than 365 days. That's a very, very important provision which has hit them, like the money market, or I'll say the company's funding, very badly. Secondly, here the security deposit is fully exempt. It does not trigger the 365 days criteria under the deposit rules. What is security deposit? Towards the performance, you give some money, advance money, which is not to be adjusted with your recurring dues. But if there is a default when the term of your contract is getting completed, then it would be adjusted in. Thirdly, advance against immovable property has to be adjusted against such property as per the terms and conditions. There may be the long-term projects for which you give advance. You place an order for some plant and machinery. It will take 2 to 3 years time. You give, then it is exempt. So the 365 days criteria is not applicable to security deposits. 365 days criteria is not applicable to advance against long-term projects. Another is once you borrow from banks or institutions, and as per lenders stipulation, promoters have to contribute some money, and the promoters can bring this money from their group, and that is also exempted, provided such condition is there in the sanction letter for the loan or the funding by such institution. Now, such loan keep to be exempted only till this loan is subsisting or outstanding. There is another very important relaxation was given in the deposit rules to the startups. If your company is registered as a startup and you borrow by issue of convertible notes 25 lakh rupee or more to single party, then it is not a deposit. But less than 25 lakhs would certainly be a deposit for a startup unless you claim exemption from some of the categories. These are, friends, some of the categories which we say the exempted borrowings. On the other hand, now once we go through the provisions of section 185, it is corresponding to section, friends, section 295 of the Companies Act 1956. Now, section 195 of the Companies, 185 of the Companies Act, it's very interesting section. It was drafted in such a manner that all related party loans or such financial transactions by which there was an obligation of a company, there could be an obligation on the company, had been just done away with. But in 2017, again, some amendment were brought in by which life has been slightly made comfortable. Now, let's see the provisions of section 185(1). Now, it says no company shall directly or indirectly advance any loan, including any loan represented by a book debt, or give any guarantee or provide any security in connection with such loan. It means a company cannot give a loan, cannot give a guarantee, cannot provide security on its assets. For what? For the loan which is taken by a director. If the company cannot give a loan to a director, totally prohibited. Even if you pass a special resolution, not possible. It is violation of 185(1). You take central government approval. Central government approval is not the provision. Therefore, your application would be rejected. It does not have the power. So no company can give any loan to the director. No company can give guarantee for a loan taken by a director from third party, maybe a bank or institution or third party. Nor a company can give charge on its assets, movable or immovable, for a loan taken by a director to the third party. It is totally prohibited. Not only this, even we can't do it for the director of the company or director of its holding company. Suppose your company is having a holding company. Holding company, they are different directors because the holding company has the command, control over the management of the subsidiary company. Therefore, you may have a pressure to give such thing. Therefore, a loan cannot be given to the director of the company or its holding company. Guarantee cannot be given for the loan taken by a director of the company or director of the holding company. Security cannot be provided for a loan taken by the director company or its holding company. Secondly, there is also a prohibition that you cannot give loan to partner of a director of the company or its holding company. Loan to partner. Can you give a loan to partners relate to the partnership firm itself? That is also because partnership is not a person. Therefore, we cannot give a loan to such partnership firm in which director is a partner because their definition is different. Now, we also cannot give a loan to relative of a director or its holding company. So to the director, now we cannot give loan to a partner of a director. We cannot give a loan to the relative of a director, not only of the company, but also holding company. Now, friends, there is a very, very important language which is used that no company shall directly or indirectly advance any loan, including any loan represented by a book debt. What is a loan represented by a book debt? See, there is a prohibition in giving loan to the director, but there is no prohibition in selling the goods to a director. That will fall under section 188, related party transaction. Now, if I sell the goods to a director or his relative or to a partner of a director on credit, and the credit term, for example, for say it is 30 days time, and within 30 days the director doesn't pay, or director's relative doesn't pay, or the partner of a director doesn't pay, will it be violation of section 185? When I give, it was related party transaction, I comply with section 188. But when the credit period runs over, what was agreed upon, it is a loan represented by a book debt. Your book debt now has become loan. Then also there is a violation. Therefore, you have to be very, very clear while having such related party transactions with the directors of the company or their relatives or their partners. If you are extending this on the credit term, never overrun the credit period. Otherwise, it would be violation of section 185(1). Now, friends, section 185(2). Now, before we move to 185, see, can we give loan to the following related parties? Partnership firm, LLP, trust, or HUF? Answer is no. Where the directors are having interest, we cannot give loan. Why? Many of the time we come to a conclusion reading section 185(2). Now, 185 to say a company may advance any loan, including any loan represented by a book debt, or give any guarantee or provide any security in connection with any loan taken by any person in whom any of the director of the company is interested, subject to lending company has passed a resolution, a special resolution in a general meeting. It means lending company should pass that members give their or accord their permission or consent to give loan to this organization. Now, can I pass a blanket resolution? Looking at the provisions, it is not possible, it is not feasible, it is not workable. Every time you give a loan, pass a special resolution. Once you pass a special resolution, irrespective of the type of company, private or public, we have to file within 30 days, MGT 14 under section 1173 of the Companies Act. Now, why I say so? See, it says proviso of 185(2)(a), provided that the explanatory statement to the notice for relevant general meeting shall disclose the full particulars of the loan given or guarantee given or security provided, and the purpose for which guarantee given or security, for the purpose for which loan or guarantee or security is proposed to be utilized by the recipient of the loan or guarantee or security, and any other relevant facts. It means each time the purpose of the loan, for what purpose it would be utilized, it may be different. Then it says before giving loan, it may advance any loan. It does not say loans, including any loan, unless these conditions are satisfied. First condition, pass a special resolution. Therefore, my reading, this interpretation goes, we have to pass a specific resolution if we want to give a loan to any company in which any of the person in whom the director is interested. When we talk about any of the company in which my director is interested, friends, it says any private company of which any such director is a director or member. A company giving loan to another company which is private, and your director is a director or member. Member may be second name holder, third name holder, or he is on the register of member. Even if he is holding the preference shareholders, he is a member under Companies Act. So equity shareholding jointly or sole, preference shareholding jointly and sole, or he is a director on the board, the company to which you want to give a loan, then obviously he is interested on, obviously you have to pass a special resolution. Any body corporate at a general meeting of which not less than 25% of the total voting power may be exercised or controlled by any such director or two or more such directors together. So my one or more directors are holding 25% shares in that company. And then obviously, then again, they are interested. Third is any body corporate, the board of directors, managing director or manager whereof or is accustomed to act in accordance with the directions or instructions of the board or any of the directors or directors of the lending company. If the company to which you are giving the money, lending the money, is accustomed to act by the instructions of your directors or managing director or board of director, any such body corporate. Here, the term body corporate has been used in the explanation. Therefore, many a time many of the professionals do feel that body corporate includes LLP. Therefore, by passing a special resolution, I can give a loan to LLP. But when we go through the clause B of subsection 2 of section 185, it says the loans are utilized by the borrowing company for its principal business activities. Loans are utilized by the borrowing company for its principal business activities. What here the terminology used is borrowing company. And the definition of company registered under this act, it means Companies Act 2013 or any of the previous acts. You can say the Companies Act 1956 or Ordinance of 1942 or Companies Act 1913 or Companies Act 1865 or 1882. These were some earlier Companies Act. So loans are utilized by the borrowing company. That means the borrowing entity should be a company. Borrowing entity cannot be LLP, though it is a body corporate, because that specific provision is there. So 185 from that angle, friends, becomes very, very important. Now, there are, once we go through the provisions of section 186, 186, friends, talks about a company cannot have more than 2 layers of subsidiary. See, as far as the 2-layer subsidiaries are concerned, 2-layer subsidiaries were basically introduced by the Companies Act 2013 by way of section 186(1). Now, what is 2-layer of subsidiary? See, there had been chain of subsidiaries, what we call step-down subsidiaries. Company A has subsidiary B, B has C, C has D, D has E. 5 channels. Now, there is a definition of subsidiary. A company which is subsidiary of a subsidiary is also your subsidiary. That's extension. Now, it says a company cannot have more than 2 layers of subsidiary. That provision, friends, had already been implemented now. Earlier, it was from 4th January 2017. Earlier, that section was not implemented for, you can say, 14, 15, 16, 17, almost for 3 years. Now, when we go through the company's layers of subsidiary rules, it is not in any other rule, but there is a layers of subsidiary rules. It says a layer of foreign company and layer of wholly owned subsidiaries to be excluded. It means the entire layer, company A has 2 wholly owned subsidiary, B and C, then this layer goes out. But if company A has B and C as wholly owned and D as a subsidiary not wholly owned, then it is not exempted. So it is not excluded. Likewise, if you have the entire layer of a foreign subsidiary, it is also exempted. Many times you have one company in India, holding company. You have the foreign subsidiaries. Those foreign subsidiaries are the step-down subsidiaries. Step-down subsidiaries in another foreign country or different foreign countries in another subsidiary. No problem, because all that entire layer is in a foreign country. But if particular layer has few companies in India and few in foreign countries, then the entire layer is not exempted. It would be counted as a layer. So while and once you have the layer of subsidiaries to check with, just have the restructuring to comply with the law. Friends, there are many provisions in which, see, lot of exemptions are given. Even section 185 is given or exempted when the loan is given by a company to its wholly owned subsidiary. See, when a holding company wants to give a loan to subsidiary, wants to provide a guarantee for loan taken by the subsidiary, you have to pass a special resolution. Loan given to the subsidiary has to be utilized for its own objective that we discussed, section 185 too. Now, section 185 is fully exempted when the loan is given to wholly owned subsidiary. The definition of subsidiary extends to the step-down subsidiary, but the definition of wholly owned subsidiary is not provided, not given in the Companies Act. Normally, we understand that when entire shareholding of a company is held by another company, entire shareholding, along with its nominees, obviously, because if I have got a private wholly owned subsidiary, I need 2 shareholders. 100% shareholding I give to the one company, then I am not complying with the basic requirement of having 2 shareholders. Therefore, I can have 1 nominee extra, which is allowed under the provisions of the Companies Act. When I have got the wholly owned subsidiary, which is a public company, I can have 6 more nominees. Investment is made by the holding company, but the nominees' names are there. Nominees are holders for which nominee and the company may file MGT 4 and MGT 5 under section 89. And then obviously MGT 6 is to be filed by the company. Now, maximum lending capacity. Now, my question is whether can this exemption be passed on to a wholly owned subsidiary of my wholly owned? There is no definition. The main parent company does not hold any share in the step down wholly owned. No shares. My entire shareholding, A is holding entire shareholding in B, B is holding entire shareholding is in C. So can a grant loan to C, which is wholly owned subsidiary, it is subsidiary, or you have to pass a special resolution? That's my question. So in my view, because there is no definition, even when we have this form accounting, we have the form for accounts, form 1. in which also we don't show our direct shareholding in the company. We show in the list of subsidiary, but not. Therefore, it's a dicey question whether step down wholly owned is your wholly owned or not, whether these exemptions could be claimed or not. Under section 186, friends, there could be the what is the maximum lending, investment and guarantee capacity. It is 60% of the paid up capital or free reserves, or 100% of the free reserves, whichever is higher. Now, with this much, the board is competent. Decision is to be taken by the board of directors in its meeting. Circular resolution is not allowed. You have to have those like in the board meeting, which you had given the due notice to all the directors of the company. And the consent of all directors who are present of the meeting should be taken. Many times, for loan, can you delegate? Here, there is a very, very important provision, friends. Section 179(3) permits that section 179(3) clause D, E, and F, giving loan, making investments, or borrowing, can be delegated to the committee of directors. Section 179(3) permits. But when there is a specific section 186, it does not allow giving of loans and making investment as a delegatable power. It says it has to be done in a meeting of the board with the consent of all directors present at the meeting. So 179 is a general provision, 186 is a specific provision. So I can constitute in my committee the borrowing committee, the committee of directors, which has been delegated the authority to borrow the funds for the company up to certain limit, no issue. But I cannot delegate the power to make investment or to give loans or to give warranty. That is not allowed. Only borrowing is allowed because 186 is very specific to that extent. Now, section 186(7) says in every case, the company, whenever it gives a loan, it has to charge an interest which shall not be less than the yield which is there on the government security for 1 year, 3 year, 5 year, or 10 year maturity yield. Therefore, without interest, a company cannot give any loan to anybody, any person, whether it is a company, wholly owned subsidiary. Wholly owned subsidiary, only section 186(3) is exempt. It means this 60% ceiling is not applicable, and of 60% of paid up capital and free reserves, or 100% of free reserves is not applicable when I give loan to the wholly owned subsidiary, but I have to charge interest. Now, section 186, friends, again is very, very important, which says that in many type of companies under section 186 is exempted from the provisions of this act. Now it says a banking company, insurance company, housing finance company, or of which ordinary course of business establishing object engagement business of financing industrial enterprises, investment made by an investment company, right issue allotments or your offer, then it is exempted. Now, for infrastructure company, here there is another very important provision, section 186(11)(a). Lastly, it says or of providing infrastructure facilities. So if you have an infrastructure company, the definition of infrastructure is covered in Schedule 6 of the Companies Act. If your item covers section 186 is fully exempt, not only the limits, but the entire section is exempt. Does that mean that I can give loan free of interest to my any party when you are an infrastructure company? It is lost to the company. Transfer pricing provisions would be applicable. Therefore, minimum rates, though you may claim exemption from the other provisions, but at least the rate of interest, because it would be lost to the company, other provisions would quit. We should cover this. As far as the related party transactions are concerned, friends, in the related party transactions, see, three things are very important. When the transactions are at arm's length in ordinary course of business and repetitive is nature, you are buying and selling the goods on day-to-day basis, multiple invoicing is made to a related party, then obviously you cannot take board approval every now and then, because we should have minimum 4 board meetings in a year and with a time gap of not 120 days under section 173 of the Companies Act. So that is one question. Therefore, friends, the rules provide that you can delegate this authority if you have an audit committee under omnibus approval once in a year you can pass this limits. During that limit, audit committee may approve and you can continue to have such transactions, but entry in the register of contract is to be made. Secondly, when the transactions are not repetitive in nature, then board approval is required. But under section 186(1), again, the board approval is not required if the transaction is at arm's length and ordinary course of business. Now, what is at arm's length and what is ordinary course of business? It's a dicey question. As a chartered accountant, your duty is much more than just helping, accommodating your clients. Because what is in ordinary course of business? It should be in the main object activity of the company, your company of which you are conducting audit, not the other company. Many times, many activities are covered in the ancillary objects. Ancillary object is basically every company has to do so many activities. So ancillary object we should not cover, only the main object activity. Suppose there is a power company and power connection is at the MD's place. Now, every month invoicing is done by the company. Then obviously you are running a club and the one of the director is also a club member, he use club facilities. So should I go every time? No, it could be all related party transactions through omnibus approval could be approved, which is not repetitive in nature and arm length. Obviously you can make an entry in the register of contract, and which is one-off entry, suppose leasing of the premises, giving on rent, buying of the property, it is one of the transaction, therefore it has to be approved in the board meeting. Entry in the register of contract has to be made. And thirdly, friends, when the transaction is large size, more than 10% of certain criteria, you have to go to the general body and take approval. Under LODR, if your company is listed, the related party transactions becomes more crucial. So these are, friends, some of the provisions. With this, I'll close my discussions on this. If you have any questions, we can take up those questions. Thank you once again to the Continuing Professional Education Committee of the Institute of Chartered Accountants of India for providing me this opportunity to deliberate for one session of 1 hour during this webinar. Thank you once again for giving this opportunity. Any questions? I'll take up if you had any.
We have two questions.
Yes.
The first question is how to disclose related party transaction in financial statements.
See, as far as the related party transactions in the financial statements are concerned, there the related party transaction is as per accounting standards. Accounting standards have even the financial transactions. Accounting standard, financial transactions are all a related party. Companies Act, it is only buying, selling, and those goods and services. Therefore, we should not just copy the related party transaction. Whatever is given in Ind AS or accounting standards, those things with the subsidiary companies, with the KMPs, even the year-end balances, opening balance, transaction, buy, sell, borrowed, lend, repaid, all those transactions we have to give in, but same to same, I don't have to make an entry into the register of contract. Now, what I have to approve in the board meeting, suppose my company is an unlisted company, LODR is not applicable, then obviously the transaction, which is the financial transaction, will not be reflected because I am an unlisted company. Though it would be reflected in my financial statement, but not in my approval in my board meeting, for approval in my other documents. Second question.
Sir, the next question is transactions between 100% subsidiary to be reported in the annual accounts.
See, it is ultimately a wholly owned subsidiary is also a subsidiary first. And related party definition includes transaction with the subsidiary. It also includes if you have a common holding company. Suppose I am a subsidiary and having transaction with the subsidiary of my holding subsidiary. What I say, it's a co-subsidiary, sister concern. Same siblings, I would say. Then also it is a related party. So if I sell any goods to that entity, obviously the entry has to be there. It is a related party under Section 2, subsection 76 of the Companies Act 2013.
Sir, the next question is a bit long. If a private company provides bank guarantee to a third party on behalf of a listed company, the listed company receives mobilization advance from that customer against the bank guarantee. Now, later the bank guarantee is invoked and the private company pays guarantee amount to the customer. Whether this advance is deposit under these rules?
See, the question is, you are taking security deposit. Basically, see, it gives a guarantee. So that's different provisions which will play, and you have to comply with those provisions. It is giving you a security. Now, is it an advance? It is not a loan given. It is a security deposit against performance. So as I discussed, security deposit is not a deposit. It does not comply with, but within a reasonable time, this amount has to be refunded. Think of a situation. Suppose I have got a director, I borrow money from the director, but after resigning, his loan when he was a director, which he paid to the company, should be repaid on the date of his resignation. Whether it would be a deposit, the date on which he ceases to be a director. Answer is no, because it says the person should be a director. Loan taken from a person who was director at the time of giving loan. Yes, he was a director on time of giving loan. So, was it a short term or long term? Why I referred section 74, under section 74 to the old deposits when they were borrowed, exempted, which were no more exempted, 1 year time was given. So we can say within 1 year from that deposit cease to be exempt, or maturity date, whichever is earlier, we should repay. That inference we can withdraw.
Thank you, sir. That is all for the questions. It just shows that how engaging and how in depth and in context you have explained with a less number of questions. We have had 503 participants for your session, 513 registration, and 513 participants. That's like a full attendance in your sessions, and with just 3 questions, it just shows how clear they have been with everything that you have explained. Thank you, sir. You still have the same in depth and in context giving of knowledge as you had 15 years ago. Thank you for such a wonderful, delightful session and enhancing our knowledge. Thank you once again.
Thank you very much. Thank you.
Now
you may continue.
Yeah, thank you, sir. We'll now take over. We'll now start with our second session of the day. And the second session is audit, assessment, and litigations under GST, which will be taken by Shri Brijesh Ji Thakkar. So I'll introduce him. He has an expertise in GST litigations and consultancy. He has delivered more than 200 sessions on GST for CAs, tax practitioners, and revenue officers on various platforms. He has been selected as GST trainer by ICAI and has also authored 3 books on GST, which is widely used by professionals. Thank you, sir, for coming. And I give over you the session.
Thanks a lot. Thank you very much, the CP committee of the ICI, for inviting me for the session on assessment, audit, and related litigations under GST. This being a very important topic, I have prepared a presentation on this. We will take the session like this. I will share the screen. So let me first share my screen. So we need to cover following points in this session. We will understand the provisions of assessment. We will also compare various sections under GST law for assessment. Now, certain questions will also arise regarding the assessment and audit, because what happens is under certain provisions of assessment, the assessment orders can be passed even without resorting to section 73 or section 74. So we need to understand under which situations directly an assessment order can be passed without resorting to section 73 or section 74. Another question also comes regarding opportunity of being heard, whether it will be compulsory for the adjudicating officer to provide you an opportunity of being heard in all the sections of the assessment. One question which repeatedly comes is that the adjudicating officer is asking for detailed records like stock register, input tax paid, ledgers, etc. during the scrutiny under section 61. You must be aware that section 61 is a section which is regarding the scrutiny of returns. So during the scrutiny proceedings, the adjudicating officer is asking for detailed records like the stock register, input tax paid, ledger, etc. Whether he is right in law for asking this kind of detailed information, that also will answer. Then how the based judgment assessment under section 62 can be made, where whatever is the decision or whatever is the judgment of the adjudicating officer, whether that can be considered as based judgment, what the rulings of the court is saying regarding these things, that also we discuss. After completion of assessment, we are going to discuss about audit and the time limit for completion of audit, whether it can be extended or up to what period it can be extended, and what is the time limit for completion of audit. So these are some of the points I have listed down which I need to cover during this session. Before we understand the things from the sections, it starts from section 59 to section 64 regarding assessment, and two sections on audit, that is 65 and section 66. So before we proceed for those sections, let's understand what is the meaning of assessment under Income Tax Act. The Income Tax Act under section 2(11) of the CGST Act defines assessment as: assessment means determination of tax liability under this act and includes self-assessment, reassessment, provisional assessment, summary assessment, and based judgment assessment. So any proceeding in which the result is the determination of tax liability of the goods and services tax is considered as assessment under section 2(11). That includes self-assessment, reassessment, provisional assessment, summary assessment, based judgment assessment. What these all kinds of assessments are, that also we are going to understand. Let's start from the first section on assessment, that is section 59. Now, what is section 59? Section 59 is talking about self-assessment. We are aware that in the modern taxation laws, the liability is on the shoulder of the taxpayer, that he himself is required to assess his liability. He himself is required to file his return. Basically, it is return, a normal return, return 3B. So the return that you file, in most of the cases, return 3B is nothing but the self-assessment. That is, you on your own are assessing your liability. You are saying to the GST department that this is my turnover, this is my eligible input tax rate, and this is the net amount payable by me. This is nothing but a self-assessment under section 59. So self-assessment we all can understand properly. Let's go to provisional assessment. Now we can understand or bifurcate the session like this, that the provisional assessment and self-assessment we understand, and then after 61, 62, 63, 64. Because 61 to 64 onwards, whatever sections are there, they are very important sections. Provisional assessments are rarely used. What happens in case of provisional assessment? Section 60 of the CGST Act provides for the provisional assessment. Provisional assessment cannot be done suo motu by the officer. Provisional assessment can be done only at the request of the taxable person. So the SSE or the taxable person applies to the proper officer that I am unable to determine my tax liability. So I request you to determine my tax liability on the provisional basis. Then if such kind of request is received, then provisional assessment will be done by the officer. What is the time limit for passing the provisional order? Provisional order means provisionally you are required to pay this much. Afterwards, we will make the final assessment, and final assessment may be more or less than whatever assessed liability is there in the provisional assessment. So it can be more than provisional assessment also, it can be less than provisional assessment also. If it is more, what will happen? That also we will discuss. If it is less, what will happen? That also we are going to discuss. But once you submit the application or the request for provisional assessment, within 90 days, a provisional order will be passed. Once the provisional order is passed, then the officer may require you to execute a bond. Now, what this particular bond will be, let's say he is saying that provisionally your liability is 1 lakh rupees, but it may be higher than that after we finally verify your records and details, and it may come to, let's say, 1,50,000 rupees. So you are required to execute a bond for that 50,000 rupees. Now, there will be a security also which is required to be furnished. Maximum 25% of that bond amount security you are required to furnish. Once the provisional assessment is completed, then within 6 months from the date of communication of this provisional order, a final assessment will be done by the officer. This 6 months period can be further extended by the commissioner or additional commissioner by another 6 months. So this is the provision of provisional assessments. How the interest will be charged, that we will verify. So friends, what we have understood is provisional assessment is not a final assessment. Once provisional assessment is done, within 6 months plus extended period of another 6 months, final assessment can be done. Final assessment may be higher or lower than the provisional assessment. If it is higher than the provisional assessment, whatever provisional assessment figure he has given you, you might have paid that particular tax. Now, the final assessment is higher than the provisional assessment, then you are required to pay interest at the rate of 18%. From which date? Then the original date on which your liability occurred, from that date to the date of actual payment. For that much period, you are required to pay 18% interest. Let's assume a situation where the provisional assessment figure is higher, but the final assessment is less than the provisional assessment. So you are eligible for refund. For refund, they are not going to give you 18% interest, nor they are going to give you from the date of your actual payment. What they will do, they will ask you to file a refund application. You file a refund application, and within 60 days from the date of filing the refund application, if you are not getting the refund, then you will get 6% interest. From which date? Then the date will commence from the end or the expiry of the 60 days. Until the date you are getting the actual payment, up to that much period you are going to get the interest. So when it is about taking the interest, it is 18% starting from the original liability. It is about giving the interest by the department. It is after expiry of 60 days from the filing of the refund application till the date of actual refund. Now friends, this is the provision of rule number 98. I am not going to discuss this thing in detail because how this application will be made, how everything will be done, that has been mentioned here. Just a second. Now let's come to very important provision. The very important provision is scrutiny of returns. Now here there may be many questions in the minds of participants. They may be facing many of the issues in scrutiny of the returns. First and foremost question comes that officers are regularly asking for detailed records when they are selecting our returns for scrutiny. So before I answer that question, we need to understand the provisions of section 61 in detail. Once we understand these provisions in detail, then after we can say that whether you need to provide those details to the officer or not. What this section 61 is saying, it is saying that the proper officer may scrutinize the return and related particulars furnished by the registered person to verify the correctness of the return and inform him of the discrepancies noticed, if any, in such manner as may be prescribed, and seek his explanation thereto. In case the explanation is found acceptable, the registered person shall be informed accordingly, and no further action shall be taken in this regard. Now, friends, rule number 99 is applicable for section 61 regarding scrutiny of the returns. Scrutiny we understand like this: whatever returns you file, you can read first 2 lines. They are saying the proper officer may scrutinize the return, each word is important, and related particulars furnished by the registered person to verify the correctness of the return. So what he is going to scrutinize is any return or related particular that is furnished by the registered person. If there is any discrepancy, he will issue the notice. The notice form, we understand it as ASMT 10. In ASMT 10, he will issue the notice. In ASMT 11, you are required to file your reply. If your reply is satisfactory, then he will pass an order in ASMT 12 that the things are satisfactory, nothing else is required to be done. Further things, if no satisfactory explanation is furnished within a period of 30 days of being informed by the proper officer or such further period as may be permitted by him. So within 30 days you are not filing the reply, or let's say the date is extended, still you are not filing the reply, or if you have filed the reply but it is not satisfactory, the discrepancies are not corrected. Let's say you are accepting that this is a discrepancy, but I am failed to make the payment in the next month's return. Then what he can do is he can resort to section 65 or 66 or 67 or 73 or 74. Now 65 is about the departmental audit. 66 is special audit. 67 is the inspection of the taxable person. 73 show cause notice in cases other than fraud, collusion, willful misstatement, suppression of fact, and 74 is applicable when there are cases of fraud, collusion, willful misstatement, suppression of fact, etc. What we understand from this many lines is that section 61 independently does not decide your liability. Section 61 is only a trigger point. So once the trigger point is triggered, then automatically your liability is not decided if your explanation is not satisfactory, or you are not making the payment of tax, or you are not giving the reply. Then he will resort to other sections. So under section 61, he cannot pass a final order for determination of tax. For that, he is required to go to either audit or special audit or inspection, or show cause notice will be issued under 73 or section 74. This is a main difference between section 61 and other sections of 62, 63, 64. So basically, scrutiny of returns is a preliminary analysis, we understand it, and not a detailed analysis. So here I have given a chart that in ASMT 10, notice will be issued. ASMT 11, you will file the reply. If the reply is satisfactory and is accepted by the proper officer, he will pass order under ASMT 12 that all the proceedings are dropped because the satisfactory reply has been furnished by the taxable person. This is rule number 99. Now one instruction is also issued as an SOP. Instruction number 2/22 under section 61. They are saying that how the returns will be selected for scrutiny. Then there is one authority called Directorate General of Analytics and Risk Management. They have been assigned the task to select these GSTs for whom the scrutiny will be done. They will provide the relevant details or data pertaining to returns to be scrutinized. This details is a dynamic detail. There will be certain parameters. And the parameters are the indicative list of parameters on the basis of which the proper officers can issue the notice under ASMT 10. So this ASMT 10 will be issued for a specific financial year. Please understand this thing carefully. Under section 65, audit can be done for one financial year or multiple financial years. Whereas under section 61, scrutiny of the returns, scrutiny cannot be done for multiple financial years. It has to be for specific financial year. So ASMT 10 must be for a specific financial year. Now, important question that comes here in our mind. Can the GST officer ask for detailed records like stock register, copies of invoices for outward or inward supplies, copies of delivery challan, etc.? This is a regular experience of many of the consultants, many of the chartered accountants, that ASMT 10 is issued, we filed a reply. Now they are saying that give us the full details from whom you have purchased to whom you have sold, give us the full copy of the stock register, etc., etc. So whether this kind of information demand is within the scope of section 61 or not, I will give you my opinion. See, we need to understand the difference between scrutiny and audit. See, scrutiny is having very limited scope. Scrutiny has not been defined anywhere in the GST law, but Oxford Dictionary defines scrutiny like this: to look at or examine someone or something carefully. So it's merely to looking at something or examining something. But examining or looking what? Looking the return or the particulars furnished by the taxable person. We have read this particular sentence in section 61. Now, what is audit? Then audit has been defined under section 2 bracket 13. Audit means examination of records, returns, and other documents maintained or furnished by the registered person. Here the words used are not furnished. They are saying it is maintained or furnished by the registered person under this act or rules made thereunder or under any other law for the time being in force to verify the correctness of turnover declared, taxes paid, refund claimed, and input tax credit availed, and to access his compliance with the provisions of this act or rules made thereunder. That means if you read the definition of audit, it is a very wide definition. It covers all kinds of examinations of the records written, whether it is furnished or not. Even if you are maintaining those records, it is within the scope of audit. So scrutiny scope is limited, audit scope is larger. Now, if an officer is asking me to provide the details and names of all the parties from whom I have purchased the goods, whether they have paid the tax or not, if he is asking me to provide the copy of the ITC register, copies of all the delivery challans, doesn't it mean that he wants to do the audit? Because this kind of examination is covered within the definition of audit and not within the definition of scrutiny. So we can humbly request the officer that if you want to do audit, then do the audit under section 65. You cannot do the audit under section 61. 61 is a scrutiny section. You initiate a provision of scrutiny and you start audit, that is not permissible under law. Law permits to do audit only under section 65. But one catch is there here, that if he is not satisfied or if your reply is not appropriate, then he can take the route of section 65. But the route of section 65 cannot be taken under section 61. So this is my opinion. Under scrutiny of returns, this kind of documents cannot be asked. Some other paragraphs of this instruction number 2 bracket 2 bar 2022 can also be referred, where the department itself is saying that in case of scrutiny of the returns, there should be minimal interface between the proper officer and registered person. There should normally not be any need of seeking documents record from the taxpayers before issuance of ASMT 10. The officer shall issue notice to registered person in ASMT 10 informing him the discrepancy notice, seeking explanation thereto. While issuing such notice, the proper officer may, as far as possible, quantify the amount, interest, and any other amount payable in relation to such discrepancies. It may be ensured that the discrepancies so communicated may, as far as possible, be specific in nature and not vague or general. So, as I told you earlier also, this is a very specific section talking about specific discrepancies, asking you to provide specific information for specific differences. You cannot do audit under section 61. This is what I am saying. So he will not issue any vague notice. He will not issue any general notice. He will specify that how much is the difference and how much is the tax payable because of this discrepancy. Only for that point you are required to provide the explanation or the information. Once we have understood section 61, the scrutiny of returns, now we can understand 62, 63 and 64 in a combined way. First, we'll understand where or in which cases 62, 63 and 64 are applicable. Then the detailed provisions we can discuss. See friends, section 62 is basically a based judgment assessment. You can also call 63 based judgment, you can also call 64 based judgment, but the primary provision for based judgment is section 62, where it is applicable, where you are not filing returns. In those situations, this section 62 is applicable. Please understand one very important thing. This kind of provision was also there in service tax, section 72 capital A, based judgment assessment. But it was applicable in two cases. One, when you are not filing the returns, and number two, even after filing the returns, you have failed to assess your liability. You are not providing information to the officer, etc. In those situations, based judgment assessment could be triggered in case of service tax under section 72 capital A. Under income tax also section 144 is their base judgment assessment. But as far as the GST is concerned, section 62 based judgment assessment can be resorted by the officer only in the situation of non-filer of returns. Meaning thereby, even if a notice under section 46 is issued to you that please file your returns, you have failed to file your return under section 39, that is a monthly return, or you have failed to file final return under section 45. In those situations, base judgment assessment under section 62 can be made. When section 63 assessment can be done, then it is applicable either to unregistered persons or to a person who was registered but his registration is now cancelled. So if the registration is cancelled, then under section 63 assessment can be done. And 64 is a summary assessment. In certain cases, to protect the interest of revenue, a summary assessment can be made under section 64. So as we have understood when 62 will be applicable, when 63 will be applicable, when 64 will be applicable, let's understand this provision in somewhat detail. 62. As I told you, 62 is applicable when a registered person fails to furnish the return under section 39. 39 is that monthly return 3B. Or 45. 45 is final return. Even after the service of notice under section 46. So 46 notice asks you to file the return. Even if the notice is issued, you are not filing the return. Then the proper officer may proceed to assess the tax liability of the said person to the base of his judgment, but taking into account what all the relevant material which is available or which he has gathered and issue an assessment order. So you do not file return. They will do the base judgment assessment on the base of the relevant material that is available with them or that they have gathered, and they will issue the assessment order. Please understand one very important thing here. Before passing an assessment order under section 62, there is no provision of giving an opportunity of being heard. Why it is not given? Because section 62 further says that once a base judgment assessment is passed and within 30 days of the date of that assessment order, you are filing a valid return, then automatically that base judgment assessment order will be withdrawn. So at the time of making the base judgment assessment, there is no need to give you opportunity of being heard, because even after making this assessment, you have an option of filing the return and the assessment order will be automatically withdrawn in those situations. How much is the time limit within which this assessment order can be passed? Then they are saying within 5 years from the due date of filing annual return under section 44. So let's assume that for the year financial year 21-22, the due date of filing return is 31st December 2022. So 5 years in that means 31st December 2027. So on or before 31st December 2027, an order under section 62 must be passed without providing any opportunity of being heard. This is what section 62 is saying. Now, one more interesting thing is that this section 62 is having overriding effect over section 73 and section 74. So basically what happens, friends? This section 72 is a provision complete in itself. It doesn't require a root of section 73 or section 74. Because if it is a scrutiny of return under section 61, then in itself they cannot pass an order under section 61. They need to go to section 73 or 74 or 65, 66, 67. But in case of section 62, there is no need to resort to section 73 or 74 directly. This can be done. 62 bracket 2 further says that within 30 days from the service of the assessment order under subsection 1, if the registered person furnishes a valid return, then this assessment order will be withdrawn. Your liability to pay late fees will continue. Your liability to pay interest will continue. That is obvious. Now, these forms in which this will be done, that has been given, this ASMT 13 DRC 07. That is fine. Important judgment is there. Here what happened in this case, because as the topic covers relevant litigations for assessment also. So friends, based judgment doesn't mean an arbitrary judgment. Please understand the difference carefully. I have not filed the GST return. That doesn't mean that the GST officer has a full right or an unquestioned right to pass an order as per his desires and wishes. He has to pass the based judgment assessment on the basis of the material gathered or material which is available with him. It should be reasonable. It should be non-arbitrary order. Because if the order is arbitrary, it will be violative of Article 14 of the Constitution. A writ petition can be filed. Same case was there in this Telangana High Court. Golden Mesh Industries versus Assistant Commissioner State Tax. Here what happened? A person did not comply with the request to file GSTR 3B. So what the officer did, the previous periods GST returns were taken. It was multiplied with 3. 3 times the monthly tax whatever was payable in the previous period. That much assessment order was passed by him. Now a writ petition was filed against this order. When the writ petition was filed against this order before the Honorable Telangana High Court, the High Court observed that the method applied by the adjudicating officer of multiplying the turnover with 3 is not based on any principle. The court asked to the officer, what principle you have followed? How it has been multiplied with 3? There was no sufficient and appropriate answer given by the officer. So High Court said that you have the power to do the base judgment assessment, but it cannot be arbitrary one. You cannot multiply with 3, you cannot multiply with 4, you cannot multiply with 2 as per your wishes and desires. It must be based on some principles. So you have failed to furnish the details on the basis of which, or you have failed to explain to the court or satisfy to the court that which is the principle on the basis of which this 3 times multiplication has been done. This order has been set aside. So the Telangana High Court has very categorically said that it cannot be an arbitrary order. The order must be passed based on certain principles, and the method adopted or the basis taken must be a reasonable and genuine basis. So fresh consideration, it was set aside and remanded back to the adjudicating authority for fresh application of mind. We have understood 59. We have understood 60. We have understood 61. We have understood 62. Now let's understand section 63. Section 63, friends, is applicable where a person who is liable to obtain registration has not obtained registration, or whose registration has been cancelled under section 29 bracket 2. In those situations, this can be applied. How much is the time limit within which the assessment order can be passed? Then they are saying again same timing within 5 years from the due date of filing annual return for the relevant financial years. So here also again same example is there. If it is financial year 21-22, then due date of filing return is 31st December 2022, assuming there is no extension. Then the base judgment assessment can be made by the proper officer on or before 31st December 2027, even for unregistered persons or person whose registration has been cancelled. Now here, there is one difference between the based judgment assessment under section 62 and section 63. Friends, in case of section 62, there is no provision for giving an opportunity of being heard before passing an order. Whereas here, it has been specifically mentioned that under section 63, that before passing the order, an opportunity of being heard must be given. So a notice is required to be issued under ASMT 14. Please understand, ASMT 13 was directly ordered under section 62. Here the order is under ASMT 14 and summary in DRC 07. One more form is added here, that is ASMT 14, which is a show cause notice. Show cause notice is required to be issued under section 63. So without giving an opportunity of being heard, a an assessment order under section 63 cannot be passed. It can be passed under 62, but it cannot be passed under section 63. The reason is obviously very clear here. Under section 63, there is no provision of withdrawal of the assessment. Whereas in case of section 62, if after finalization of the assessment, you are filing the return within 30 days, then there is provision of withdrawal of the assessment order. Hence, there is no need to provide an opportunity of being heard, but here there is a need to provide opportunity of being heard, which has been provided by way of GST form number ASMT 14. Now, as we have understood 61, 62 and 63, let's come to section 64. Now, what section 64 is saying is summary assessment where proper officer is of the view that the delay in making assessment will adversely affect the interest of revenue. What happens sometimes, some goods are caught from some warehouse, etc., and who is the owner of that particular goods is not found. So they are saying the person in whose custody these goods are found, he is the person liable to pay tax. A summary assessment can be made, and he can be made liable to make this payment. These are the provisions of section 64. They are saying that the proper officer may, on any evidence showing the tax liability of a person coming to his notice, but please understand, it must be with the previous permission of the additional commissioner or joint commissioner, proceed to assess the tax liability of such person to protect the interest of revenue, and issue an assessment order if he has sufficient ground to believe that any delay in doing so may adversely affect the interest of revenue. One more thing is given here, where the taxable person to whom the liability pertains is not ascertainable and such liability pertains to supply of goods, the person in charge of such goods shall be deemed to be the taxable person liable to be assessed and liable to pay tax and any other amount due under this section. I have already explained this. Here also similar provision to section 62 is given. And let's say a summary assessment is made, and then after, within 30 days from the date of receipt of this order, you are making an application to the additional commissioner or joint commissioner that this order is erroneous. Then he may withdraw such order and follow the procedure laid down under section 73 or 74. So just like section 62, where assessment is finalized, base judgment assessment, you are filing the return, it will be withdrawn. Here also within 30 days, you can make the application that it is erroneous order, please withdraw. Then they will withdraw the order and they will follow the procedure given under section 73 or section 74, whatever is applicable. But one difference we need to note here between 62 and 64. In case of section 62, they are saying that once you file the return within 30 days, then the order will be withdrawn. That means there is no discretion given to the officer of not withdrawing the order. Whereas in case of section 64, they are specifically saying that if you are required to first apply that this is erroneous order, and if the joint commissioner or additional commissioner is satisfied that yes, actually it is erroneous, only then they will withdraw this order and follow the procedure under section 73 or section 74. So here for withdrawal, a discretion is given to the additional commissioner or joint commissioner, which is missing in case of section 62. There, once you file the return within 30 days, they must withdraw the assessment order. Certain rules and forms are given. We are not going into the form numbers of these things. Now, friends, as assessment provisions we have completed, we'll understand summary of these things, and then after we'll go towards, within 10 minutes, we will go towards the audit procedures, and then after within 5 minutes, we can take questions also. 61, 62, 63, 64, what is the difference? 61 is scrutiny of returns, 62 is non-filers, 63 is unregistered persons or persons whose registration is cancelled, and 64 is the summary assessment. First question is, can direct order be passed without resorting to 73 or 74? Then in all cases, 62, 63, 64, there is no need to go to 73 or 74. Whereas in case of 61, scrutiny of the returns, it is not a complete code in itself. It is not a complete provision in itself. There, it is only an initiation procedure. So there they cannot determine the tax liability without going to 73 or 74. What is the trigger point of 61, 62, 63, 64? The trigger point is 61 is when your return gets selected for scrutiny. 62 is when you are not filing the return even after issuance of the notice for filing the return. 63 is when you are liable to get yourself registered but you have not registered yourself or your registration is cancelled. And 64 is special case where they have sufficient ground to believe that delay in doing the assessment will adversely affect the interest of revenue. Then they can go for 64. Now, how the liability will be decided in all these four cases? In case of 61, liability will be either decided by 65, 66 or 67. See, even if you are going to 65, 66, 67, 73, 74 will come in the picture anyway. So obviously it will ultimately go to 73 or 74. Whereas in case of 62, 63, 64, there is no question of 73, 74. It will be as per the best judgment of the officer. Time limit for passing the order, again, time limit is not specified for section 64, but it is 5 years from the due date of filing annual return in case of 62 and section 63. In case of 61, time limit is not applicable. Why time limit is not applicable? Because it is not a section which authorizes the officer to pass an order. So whatever is the time limit for 73, 74, that will be automatically applied in case of section 61. So hence here it is not given. Opportunity of being heard, whether it is implied or not, yes, because that provision is given under section 73 and 74, and without 73, 74, 61 cannot be completed. So 61 will anyhow go to the root of 73, 74. So it is implied. For 62 and section 64, the sections doesn't specifically mention about the opportunity of being heard because there is a provision for withdrawal of the order. Whereas such withdrawal of order provision is not mentioned in 63. Hence, the provision for opportunity of being heard has been specifically mentioned. So provision for withdrawal of order not given in 61, not given in 63, but given in 62 and given in 64. In 62, within 30 days from the date of communication of the order, you are filing the return, it will be withdrawn. In case of 64, within 30 days from the communication of the order, if you are applying to the additional commissioner or joint commissioner that this was an erroneous order, and at the discretion, they can withdraw this order and follow the procedure laid down under section 73 and section 74. So friends, here our assessment portion is completed. For audit, we only need to see two sections because 35 bracket 5 is already withdrawn. That means audit by chartered accountant and CMA is already withdrawn. Audit can be done by department under section 65 or a special audit under section 66. So let's verify these two important sections of 65 and section 66. Now friends, section 65 says the commissioner or any officer authorized by him by way of a general or specific order may undertake the audit of any registered person. Now audit's definition we have already verified under section 2 bracket 13, the detailed examination of your records, returns, etc. maintained or furnished by you. As per rule 101, the period of audit to be conducted under this section shall be a financial year or multiple thereof. Again, friends, I want to reinstate that. In case of scrutiny of returns by way of issuance of notice under ASMT 10, it will be only one single financial year, whereas audit can be done for multiple financial years also. Now, the registered person shall be informed by way of a notice. Now, in which form number it is required to be given, then it is ADT 01. And it is not less than 15 working days prior to the conduct of audit. So, what we are saying is minimum 15 working days prior notice is required to be given. Here, the words used are working days. prior notice is required to be given before commencement or conduct of the audit. Now, scope of the audit is also defined in section 65, read with rule number 101 bracket 3. What he will verify? He will verify following: the documents on the basis of which the books of accounts are maintained, return and statements furnished under the provision of the act or rules made thereunder, correctness of the turnover, exemption, deduction claims, etc., rate of tax applied, input tax rate availed and utilized, refund claim, and any other relevant issues. So again, friends, the scope of audit is very wide. They can ask you the questions, they can demand explanations, they can ask for the information, they can ask for the documents and records, and you are obliged to furnish those documents and information to them when section 65 is applied. Now then they are saying he will record the observation in his audit notes. So audit notes will be prepared, he will record the observations. During the course of audit, the authorized officer may require the registered person to afford him the necessary facility to verify the books of account or other documents as he may require, to furnish such information as he may require, and render assistance for timely completion of the audit. So basically, they will come to your premises, they will examine the books of accounts, they will examine the invoices, they will examine other relevant records. They will also ask for the tax audit reports under Income Tax Act and other acts. And you are liable to furnish those things, you are liable to give them this information, you are required to render them the assistance for timely completion of the audit. Here there is one very big catch regarding this timely completion of audit. I am coming to that particular provision. But before that, let's understand this slide also. On conclusion of the audit, the proper officer shall within 30 days inform the registered person whose records are audited about the findings, his rights and obligations, and reason for such finding in ADT 02. ADT 02 is a kind of audit report that will be issued to you. They will say that these are the discrepancies, these are the things, and here you are required to pay tax, or you need to give the answer. Now let's say if under section 65 the audit paras are not dropped, then they will resort to 73, 74. Where the audit conducted under subsection 1 results in detection of tax not paid or short paid or as refunded or input tax rate wrongly availed or utilized, the proper officer may initiate action under section 73 or 74. So audit findings will be given to the jurisdictional officer, and on the basis of the audit findings, the jurisdictional officer will issue notice under section 73 or 74. Now, as I was talking about this thing, time limit for completion of audit, very big issue is there here. They are saying that within how much time audit is required to be completed. They cannot continue to come to your premises for indefinite period of time. Let's say they came in the month of January, they are coming in the month of June, then again they are coming in the month of September, again they are coming in the month of December, and they continue doing the audit. That should not be the case. The audit shall be completed within a period of 3 months from the date of commencement of audit. Now, what is the meaning of date of commencement of audit? That is important. Now, this 3 months period can be further extended, not exceeding 6 months, by the commissioner, where there is a proper reason that why it cannot be completed within a period of 3 months. But what is the meaning of commencement of audit? From when this 3 months will commence? Then they are saying later of, number 1, date on which records and other documents called for by the tax authorities are made available by the registered person or the actual institution of audit at the place of business. So here this is very big catch, because what may happen here? Let's say they have asked 15 things from you. You have provided 14 things, or 14 details, or 14 documents are provided by you, but one specific document, let's take an example of stock register. Stock register you have not provided. They have asked this thing in the month of January. Now they are coming to your premises in the month of February, 1st February. So normally from 1st February, 3 months, that means 1st of May, audit should be completed. But now this 15th item that you have not provided earlier, that you are providing on 15th of April. Then from 15th April, you are required to count 3 months. So up to 15th of July, they have time to complete this audit. So if, let's say, you are not providing all the details or documents that they have asked for, then this period will automatically extended, because commencement of audit cannot be considered to have been done. Because commencement will be considered to have been done only when you have provided all the documents called for by the tax authorities, or the date on which actual audit is start at your place of business. So this was very important provision. In here I have also given example. I have explained you through the example also, so no need to read it again. As we have completed 65, now let us within 2-3 minutes complete section 66. Provisions of special audit is given under section 66. Sometimes due to complexity of a case and to protect interest of revenue, proper officer may deem it necessary to get the books of account audited by a chartered accountant or cost accountant. It's possible that, let's say, some proceeding is going on, inspection is going on, search is going on, or other any proceeding under the act is going on, and the officer is of the opinion that the books of accounts are complex, and to protect the interest of revenue, it is required to be audited by a chartered accountant or cost accountant. Then even if your books of accounts are already audited under, let's say, Income Tax Act or under any other law, or it's an internal audit, anything has already been done, still you need to get your books of accounts audited, because this is a special audit. The provisions are like this. The direction of special audit can be given by an officer not below the rank of assistant commissioner. Direction can be given at any stage of scrutiny, investigation, inquiry, or any other proceedings. So there must be some proceeding going on against you, and whatever documents or details you are providing, whatever books of accounts you are providing, he is not able to understand the things. It's complex. So if it's complex, then he can give direction for audit. Direction can be given considering the complexity of a case and interest of revenue. Both the things. It is not or. Case should be complicated and interest of revenue should also be there. The proper officer is of the opinion that the value has not been declared correctly, or the credit availed is not within the normal limits. The direction can be given only with the proper approval of the commissioner. So it must be having a prior approval of the commissioner. Only then this direction can be given. With how much time is required to be completed? Then within 90 days. They are saying that the chartered accountant or cost accountant so nominated shall within a period of 90 days submit a report of such audit, duly signed and certified by him to the assistant commissioner, mentioning therein such other particulars as may be specified. So the assistant commissioner will ask the CA or the CMA that these are the things we want to verify, because it's a special audit. The assistant commissioner may, on application made by him, made to him in this behalf by a registered person or CA or CMA, or for any other material sufficient reason, extend the said period by further period of 90 days. So 90 plus 90. In case of 65 audit, it was 3 months plus 6 months. The audit under this section is required to be conducted even if the books of accounts are already audited under any other law. So you have already got your books of accounts audited, the audit report is already there. That is irrelevant. If a direction under section 66 is given, then you are again required to get your books of accounts audited by a chartered accountant or cost accountant nominated by the commissioner. Where the special audit conducted under subsection 1 results in detection of tax not paid or short paid or as refunded or input tax rate wrongly availed or utilized, then again you will go to section 73 or 74, they will issue the show cause notice. The registered persons shall be given an opportunity of being heard in respect of any material gathered on the basis of special audit which is proposed to be used in any proceeding against him under this act or rules made thereunder. So naturally an opportunity of being heard will be given before using these details against you. And who will bear the cost of this special audit? Then the expenses of the examination and audit of the records under subsection 1, including the remuneration of such chartered accountant or cost accounts, shall be determined and paid by the commissioner, and such determination shall be final. So it is within the rights of the commissioner to determine and pay, and he is liable to pay this remuneration and other expenses to the chartered accountant who is doing this special audit under section 66. So friends, this is the end of this session. If there is any question, I will be happy to take those questions. I think we have 5 minutes.
Yes, sir.
Yes,
We
ma'am.
have some question. I'll just read it to you. The first question is there any minimum turnover for GST scrutiny?
No, there is no minimum turnover for GST scrutiny, but there is an authority, as we have discussed in our session, that based on the risk parameters, let's say your ITC is not within the limit, or you are purchasing from someone whose registration has been cancelled, or there are certain other discrepancies, risk parameters are there. So if you are falling within those risk parameters, then under section 61, your return can be selected for scrutiny. The financial limit is not there for selection of returns under scrutiny under section 61.
The second question is the verification of Tran 1 credit claimed in October 2017 completed in December 2023. However, the order is not uploaded on the portal. Can one file GST appeal in a manual form? And what about payment of 10% of GST liability, and how can one pay it?
See, if the order is not being shown on your GST portal, then first limitation you will face is you cannot file the online appeal. It's a technical thing, first thing. Second important thing is many of the high courts have already gave decisions that when the order is not uploaded on the portal, then the time limit for filing the appeal will commence only when it is uploaded on the portal. So either you can wait till the date on which this order is uploaded on the portal, or conservatively, if you want to go conservatively, you file a manual appeal, make the payment in your cash ledger only, don't apportion it. Write a letter to the appellate authority that the order is not uploaded on the GST portal. Hence, we are not able to apportion this amount from my cash ledger or credit ledger for the payment of this pre-deposit under section 107. So that is the solution.
And the last question is if the foreign company is holding 99% shares in an Indian private company, and now again such foreign companies acquired new shares, whether such acquiring new shares will be related party transaction. I think this is
This is not
the
related to
last,
GST.
the GST, right. I think this is so, sir, right now we have 970 participants for your session, a wonderful session. Thank you for throwing light on the ever changing and ever confusing GST provisions. You very clearly and patiently explained. I was just listening to all the related provisions and along with the fitting judgments and the orders. So, thank you, sir, for imparting us with your knowledge. Thank you, all the participants. This is the end of the session, too. I hope you enjoyed it. So thank you. This is the
Thank
end
you
of
very much.
our session today. Thank you.
Thank you.